15 of 21 series are aligned with an acceleration mild regime this morning. That is a moderate level of systematic agreement that the environment features strengthening growth alongside firming inflation. The current macro regime is acceleration mild, with a confirmation score of 15 out of 21. In the framework, acceleration mild describes a macro regime where growth momentum is accelerating at roughly plus 0.10, while inflation momentum is nudging higher at around plus 0.00. That combination tells us the math is capturing a backdrop of improving real activity with price pressures that are still building, even if not abruptly. The coherent score is in a moderate band, and the confirmation score of 15 out of 21 sits in a range that, by our historical work, has persisted in roughly 47% of comparable 3-month windows. Compared to last week, the regime alignment has firmed as more series have tilted toward acceleration rather than deceleration. And the Atlanta Fed's real-time GDP tracker has been one of the largest movers, improving over the past 2 sessions. Historically, environments like this have felt like pro-cyclical markets. Commodities and energy often led. Longer duration bonds often struggled as rates pressed higher, and inflation-sensitive real assets drew attention. A record of past behavior in the data, not a script for what happens next. Let's walk through 4 signals the 21 series are mapping today, starting with interest rates. The 10-year Treasury yield sits near 4.75%, with the rate complex showing green momentum, defined here as yields rising on a sustained basis, pushing real and nominal borrowing costs higher across the curve. Markets watch the 10-year because it anchors everything from mortgage costs to equity valuation assumptions. The question it raises is simple. Does a 4.75% long rate change how much duration or equity exposure feels comfortable? In our framework's reading of comparable periods, this roughly coincided with pressure on long bonds and a tilt toward real asset performance over 3 to 6 months. An observation under our methodology, not a forecast. What would challenge this read would be a decisive move lower in yields that flips the momentum back to a falling rate environment. On the labor side, non-farm payrolls and broader employment indicators remain in focus. The framework currently tags labor conditions with a yellow momentum label, defined as employment still growing but at a slower rate of change than earlier in the cycle. Markets watch labor because hiring and wage trends shape household demand and corporate margins. The question is whether a moderation in job growth changes how much cyclical risk investors are comfortable carrying. In our framework's reading of comparable periods, this roughly coincided with more selective equity performance and greater dispersion between sectors over subsequent months, a record of past behavior, not a forecast. A clear reacceleration in payroll growth or a sharp drop in jobless claims would challenge that interpretation. Credit spreads, particularly high-yield credit spreads, which measure the extra yield companies with lower credit quality pay over treasuries, are another key signal. Today, the framework marks credit momentum as red, defined as spreads widening rather than tightening, reflecting a gradual increase in perceived risk for lower-quality borrowers. Markets watch this because credit is where stress often shows up before it hits equity prices. The question is whether modestly wider spreads are enough to challenge the current risk posture, or simply reflect repricing after the Fed's more hawkish tone. In our framework's reading of comparable periods, this roughly coincided with more frequent drawdowns in risk assets over the ensuing weeks, an observation under our methodology, not a forecast. What would challenge it is a renewed tightening in spreads that signals eased concern about default risk. For sector behavior, technology and industrials present an interesting contrast. Technology has recently been under modest pressure, while industrials have shown relative strength. The framework would mark technology momentum as red and industrials as green, defined respectively as a sustained downward versus upward price rate of change. Markets track this rotation because it shows whether leadership is concentrated in growth and AI narratives or shifting toward real economy cyclicals. The question investors ask is whether this rotation confirms the macro story of mild acceleration or challenges it. In our framework's reading of comparable periods, this roughly coincided with phases where cyclical sectors carried more of the performance load while high-growth areas cooled, a record of past behavior, not a forecast. A renewed broad-based surge in technology or a reversal in industrials would challenge that rotation narrative. The conditional map inside the framework flags specific if-then configurations. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, inflation composites historically showed acceleration in roughly 9 of 11 comparable conditions. A historical characterization, not a forecast. That kind of sustained yield move would, in the math, strengthen the case for transitions from expansion-style regimes into acceleration-style regimes. If the widely followed Fear and Greed Sentiment Index drops below 15 and stays there for 5 sessions, in our framework's reading, the confirmation score deteriorated in roughly 7 of 9 similar episodes. Again, a historical characterization, not a forecast. That pattern has historically aligned with regimes where internal coherence softened even if prices had not yet moved dramatically. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated, rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework. A reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols. The 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. This structure is built for potential educational use, to help people observe how 21 series and 407 symbols have behaved mathematically across regimes, not to tell anyone what to do. Every trading day, this is free. Watch real symbols go active in live markets at the price it's happening, see which sectors are leading, and learn to read what's driving it yourself. That live view is the observation desk. The same 21 series and 407 symbols founding members study each morning, the environment underneath every move. If you want to watch it alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members. Watch it before you risk $1. You decide.